Hello everyone. Please let me know if you can hear me. Send me a yes somewhere in the chat so I know that you can hear me and you can see my screen already. I want to make sure that I am actually streaming. Wonderful. I see some messages there. Good morning to you as well. Good afternoon, good evening, wherever you are. Yesterday we saw we had people from really many places, from Turkey to the United States, Morocco, Germany. Fantastic. Good morning, evening to all of you. Hi from the UK. Fabulous, Chris. We're very close. The sound is perfect. Phenomenal. Well, then let's begin. You know, I want to begin with some questions that I was sent yesterday. And I have to tell you, if you have questions that I did not answer, because sometimes the chat really goes very fast and I miss them. So if by any chance you have an important question that I didn't answer while we were doing the presentation, it is not because I don't want to answer, I just missed it. So please write it below the video afterwards, and when I get to the question, then I will bring it next day or next presentation, then I will answer it for you. And one of the questions that I received was, why bars? Why not candlestick charts? That's a very important question because most people want to use candlestick charts. And when they see my charts, they see that I use bars and they think that I hate candlestick charts. And that's not true. Candlestick charts are phenomenal. They are really a wonderful tool, one that really helps when you know how to read them properly. But for wave analysis, they are very confusing. So I strongly recommend against the use of candlestick charts when you're doing wave analysis. To switch from one to the other is extremely simple. So there is no need for you to actually use one or the other, use both. But when using wave analysis, there is only one type of chart that is adequate for that, and that is bar charts. You can use open, close, high, lows. That's fantastic. Or you can even use the bars by themselves. It is always important to see the closes, but the bars by themselves are probably useful as well. The point is that the candlesticks, they have shadows. And those shadows make the entire picture confusing because sometimes, actually often, what your eyes will focus is on the body of the candle. And what happened then is that you may have a very small body, like in a hammer or in a shooting star or something like that, and then miss the entire move of price because the price closed on the low or closed on the high, and then you don't really see the extreme. And by not looking at the extremes, you actually lose the extreme of the wave. So that is not very, very useful. And yes, sometimes you will say, well, you know, I will focus on the shadow as well. But that's not something that you do consciously. It's unconsciously you will tend to look at the bodies. You will tend to look at the colors, but you won't be able to look at the waves. Whereas what you are doing now by training with what we're doing is training your brain to see waves, to see those subdivisions that we have spoken, those cycles that we spoke yesterday. So based on the comments on the, well, not only on the Elliott videos, but on the many of my videos, and also based on questions sent by me, by many participants, including some of you here, I believe it necessary, before we continue, to take a couple of minutes to discuss a few objections, or I would say criticisms of the wave principle that are ubiquitous in the trading space. The first one is what I call the 2 analysts and 3 counts. You know, people always tell me the same story. For some reason, you know, when you teach somebody a little trick with a trend line, they get so interested. But when you teach something as profound as the Elliott wave, they want to dismiss it immediately, and they want to show they are so much smarter than you are by showing, haven't you heard, the 2 analysts that were in the room, or, if you put 3 analysts in the room, you're going to get 3 different counts and a different variation of the same thing, right? And the truth of the matter is that applies to absolutely everything or anything and any subject. If you put in a room 3 doctors, experts in nutrition, you probably will get 3 different interpretations as well. I'll give you an example. You get a vegan doctor, right? And the vegan doctor will give you as an advice to only eat veggies. He will tell you, don't take dairies, don't eat dairies, because milk is meant for transforming small calves into large cows. And if in the same room there is a carnivore doctor, he would probably say that plants are full of anti-nutrients, lectins and oxalates, and you should only eat fat and animal products, including milk, because it comes from the animal. Most doctors are experts on the standard American diet, and that's the SAD diet or SAD diet that is promoted by the government, pyramid. And those doctors would tell you, you need to eat meat, but in very small quantities, very low fat at the top of the pyramid. But your main food should come from grains and fiber, which we didn't hear in the other doctors, right? It should come from grains and fiber at the bottom of the pyramid. You get 3 experts in nutrition, all of them well-read, well-versed, and studied for years and have years of experience treating patients, and yet all contradicting themselves. Now, the question here is, does it mean we should never eat again? We should say, well, there are 3 different doctors with 3 different opinions, so we opt for not eating, so we will fast. That would be silly. And the same thing applies if you asked 3 religious leaders for the meaning of life. Let's say you ask a Christian or a Buddhist and Muslim, and they will give you 3 very different interpretations of life. A Buddhist would probably, and I'm not expert on any of this, but a Buddhist would probably say that the goal of life is nirvana, or freedom from suffering. A Christian will probably say that the goal of life is to learn how to love so you can go to heaven. And a Muslim will probably say the goal of life is to know and serve Allah. Even if you put 3 people of the same religion together to interpret a verse on their script, they will have different interpretations. Different interpretation of the script, different interpretation of the religion itself. The Tantric Buddhists will probably spend most of their days practicing meditation to increase their body heat and melt snow with their bodies in the Himalayas. But a non-tantric Buddhist will probably focus on their breathing and, and just emptiness and breathing. And then you find other Buddhists that will spend their days practicing martial arts. So, 3 completely different approaches. Now, that doesn't mean we should not have any religion or accept any moral guidance from whatever religion we belong to. The use of such excuse to avoid learning what I consider the most important forecasting tool in existence is extremely damaging for the potential trader or for the potential success of that trader, because as I explained yesterday, the first step to any strategy, the first precondition is to forecast. And if you don't have a system of forecasting that is sound, that is valuable, that has been proven over and over again, well, you're probably going to be gambling. You're not going to be trading. Probably one of the most egocentric excuses I've ever heard, ever since I know Elliott waves, is the excuse that Elliott wave is too subjective for me. So many people tell me the same thing. Well, you could put the wave 1 in a different place or the wave 2 in a different place. It's too subjective. Now, this is what I encounter. Those who say that Elliott wave is subjective typically are the ones who try to learn on their own, possibly by reading some books or by watching a few videos, likely on YouTube, and then of course they will fail. Not only because the books are difficult to understand, there is only one main book to learn Elliott wave, because the others are really contradicting what the main book says. And that book is very difficult to study. The book is by Robert Prechter and Robert Frost. And it's a fantastic book, but it's so difficult to understand. And of course, if you try to do that on your own, believe me, I tried myself for 7 years, likely you will fail. And I have never, ever met a person who truly understands Elliott waves and says such a nincompooperi, because that's exactly what that is, a nincompooperi. The truth is that it is exactly the opposite. Elliott wave is the most objective analytical system that there is. No other analytical system has so many unbreakable rules as the Elliott wave principle. We started yesterday with the unbreakable, non-negotiable rules of impulses. If your count violates just one of these rules by a single tick, by a single pip, it is instantly wrong. That's the end of the discussion. Now compare that to traditional patterns. Let's make a drawing here. Compare that to this. Let's say that the most famous traditional pattern there is the head and shoulders. It goes like this, right? So basically it reminds us of the left shoulder of a human being, the head, and the right shoulder. So this would be left shoulder, head, and right shoulder. Now, this pattern that is so obvious and it's been studied so often, this pattern is so subjective. Why? Well, tell you why. And you may even tell me. For instance, in this drawing, typically the interpretation of the pattern is that, well, we have a trend line that goes from shoulder to shoulder, or the lows of in between shoulders and head. That's known as the neckline. And when the neckline breaks, we typically get a move that would go the same distance that separates the head to the neckline. So we would take something like that. This distance would be when prices break the neckline, and they would be here. Now the problem is that neckline sometimes is drawn not from here, but is drawn from, let's say, let me draw this again and you will see what I mean. The necklines are typically drawn, we have this moving like this, right? So there would be a left, and the head, and the right shoulder. Okay, so sometimes the necklines are not drawn from here, but from here, like that. And so the pattern breaks here. Sometimes they are taken from here, and so the pattern breaks here. Sometimes they are taken from the subdivision here. Let's say that is like this. So it's taken from here. So there is no rule to tell us from where do we draw the neckline, and when is it going to be, oops, I messed up. And when is it going to be confirmed or correct in any way? So point is, there is no way to know, no objective way to know when a Head and Shoulders is correct or incorrect. And I have seen great analysts doing things like this. Let me show you something fascinating from even expert, veteran analysts that do something like this. Left shoulder, head, and then something like this. And then they call that a head and shoulders. Call this left shoulder, head, and right shoulder. Well, I mean, logic tells me that's not a shoulder at all. But does it count? Well, sure. Why? Because there are no rules for this. So this is a traditional pattern, one of the most famous patterns, one of the most used patterns, and yet there are no real rules. Yes, some people say, well, yes, there is a rule that if volume accompanies the breaking of the neckline, then the Head and Shoulders is confirmed. That is true. There is one, it's not a rule, it's pretty much a guideline that says, you can help yourself with volume to verify that the Head and Shoulders is indeed in progress. But it's not to tell you that the Head and Shoulders is a Head and Shoulders. It's basically to say that the Head and Shoulders, or basically that the right shoulder has broken the neckline in a substantial way, in an acceptable way, as to go short. So it's more like a guideline for trading, not for analysis or to verify if the Head and Shoulders is a Head and Shoulders at all. Typically, what a Head and Shoulders actually is this. The distance, not the distance, but the pattern formed by wave 3, 5, and B. This would be the left shoulder, this would be the head, and this would be the right shoulder. And where would be your neckline? This would be your neckline. And then what happens when this breaks? Well, typically when this breaks, it confirms that the Head and Shoulders is indeed in progress. Anyways, the point is that what I meant to say here is that there is no system in technical analysis, no other methodology in technical analysis where the rules and guidelines are so strict and precise. In Elliott wave, you get the rules of 1 pip or 1 tick to tell you are completely wrong. That means that you get for the only way to know when your position is wrong, when you can put your stop in the perfect place. Because typically, what's the problem with stops? Stops, prices go, take your stop, and then they go on the way that you intended. And then you are left behind with frustration, right? Well, that doesn't happen with the wave principle because there are clear rules that tell you is if prices go 1 pip below or above here, you're wrong. Your pattern is not what you thought it was. Nothing in technical analysis does that. The only one that does that is the wave principle. So to say this is too subjective for me is quite inappropriate, let's say. Okay, so let's move on. Let's try to start with our presentation on Elliott wave itself. And I want to first tell you, there's a question here, where would the target to be bought? Where would the target to be bought? I don't understand that question. Please restate that question in a different way that I can understand. So why the rules help us define the trend? Well, yesterday we saw that, right? We said that those rules are absolutely imperative to learn by heart because they govern everything in the wave principle. And the most important thing is that they will help you define the trend. Why? Well, because we said that we don't define the trend as higher highs and higher lows or lower lows and lower highs, but we define the trend by an 8-wave cycle. 5 waves in one direction, 3 waves in the opposite direction. So when we have this, we say the trend is down. When we have this, we say the trend is up. Okay, so the problem is that the first part of this 8-wave cycle is a 5-way move. And that 5-way move must follow the rules. Because if those 5 waves don't follow the rules, then this cannot be taken seriously to consider the trend as up, or the previous example, the trend as down. So those rules are imperative. Now the question, of course, arises, well, why so much importance on the trend? Well, because the trend is a movement that persists in one specific direction. So the key here is that it persists. So when you trade, you want to trade in the direction of the trend. You want to trade in the direction of the movement that you know will persist in time. And in order to do that, you need to learn how to identify the trend. And in order to learn how to identify the trend, you need the 8-wave cycle. And in order for the 8-wave cycle to qualify as a proper identification of the trend, you need to have an impulse on the left side that actually follows the rule. And that impulse is followed by a corrective structure, an ABC. And that impulse must follow the rules. And that's the reason why we need to have those 3 rules. Remember, wave 2 can never travel more than 100% the distance traveled by wave 1. Wave 3 is never the shortest, and wave 4 can never end in the price territory of wave 1. So when we have this, we do have a perfect identification of the trend if this part followed the rules. Now the questions here on the head and shoulders. I see you are saying where would the target be for the head and shoulders? Well, for the head and shoulders, the target typically is that, let me go back to it. Well, actually, we can do it here. Let's say that this is the left shoulder. Okay, this is the head, and this is the right shoulder. Okay, and we have the trend line that connects the dips between the left shoulder and the head, and the next dip between the head and the right shoulder. So in this case, it would be this one, right? So you connect those, and you measure the distance from the top, from the head, all the way down, all the way down to the neckline. Oh, it's not doing it. See? Oh, there it is. To the neckline. So then you take that, you put it right where the prices broke the neckline, and that is your projection. This is the ideal projection for the head and shoulders, and this would be the place where you would consider buying, of course, if you get a buy signal. So that I hope that answered to your questions. All right, so now that you know the importance of those rules and the identification of the trend and why do we want to identify the trend and all that, I want to show you the 13 patterns that Elliott identified. So I copy them here because I said, okay, that's much easier. Let's copy that. Okay, so here there are impulses, which we have spoken already about, zigzags, flats, double zigzags, ending diagonal triangles, expanded flats, contracting triangles, triple zigzags, leading diagonals, running flats, barrier triangles, expanding triangles, running triangles. Now this sounds like, oh my God, do I have to learn all that? And the answer is, well, yes. But if you try to learn it like this, you're going to go nuts. You're probably not going to remember. If I take this away right now, let's say that I do like this, and I ask you to repeat 10 of them, you probably won't be able to do that, right? Even if I show you again, if I were to show you them again and give you a minute to memorize them and then take them away, you probably won't remember 10 of them. So what we do is to try to do this in a very systematic way. Instead of learning 13 patterns like that in a disorganized way, we divide them into two modalities, and that's what we spoke yesterday. We said motive waves and corrective waves. All right? So under motive waves, we discussed the impulses. And now you know exactly what an impulse is that 5-wave move that follows those 3 rules that we discussed. So under motive wave, we have impulses and diagonals. Diagonals are a type of motive wave. It means that it develops in 5, and it means that it moves in the direction of the main trend. The only difference is that they don't follow these 3 rules that we discussed. Let's write here a D, so you remember diagonals. They follow their own rules, but we won't discuss them today until we discuss diagonals, and we want to make sure that you actually grasp and understand everything there is to know about impulses, because impulses are the ones that are going to really save you. Why? Because when you recognize an impulse that follows those 3 rules and is followed by 3 waves in the opposite direction, you have a trade setup, and it's a trade setup that will likely work. So you will put the odds in your favor. And that's the reason why you need to learn everything that you can about impulses. And that's why I'm going to insist so much about impulses. So then we have corrective waves. For corrective waves, we basically have 3. And this is really easy to remember, because you remember that we said that corrective waves developed in 3 waves, right? They seem to be unable to oppose the forces of the trend. So they are unable to develop into 5. So let's say that the trend is up, right? And then when prices start coming down, they want to go like that, but they try to develop in 5 and they can't, and they go back up, right? Because the underneath forces of the trend are to the upside. So corrections always develop in 3. And we use ABC to label them. So it's easy to remember that corrections are of 3 types. Okay, one is called the zigzag, the other is called the triangle, and the last one is called the flat. Okay, so now we have only 5 different patterns here, but very easy to remember because we have framed them. You know, we put them into an easy way to recognize them, which is motive waves, the ones that move in the direction of the trend, and they are of 2 types, impulses or diagonals. And corrective waves, the ones that go against the trend, and they are of 3 types, 3 for corrections. One is called zigzag, the other is called triangle, and the last one is called flats. Everything else is a variation of this. So when we say, for instance, let's go back to that list. When we say zigzags, okay, that's one of the corrections. But then we say double zigzags. Well, that's a variation of a zigzag. When we say contracting triangles, that's a variation of the triangle. When we say running flats, that's a variation of the flat. So basically, all we need to know is these 5 wave structures, only these 5. The rest are very easy because they are simple variations, sometimes very small variations of the main correction here. So let's not bother trying to learn all those 13 patterns and be all confused and abstract and lost in words, weird words, and instead let's use 5 structures. 3 of them are corrective structures, which are easy to remember because there are 3, okay, and corrective structure move in 3, and motive wave, which are impulses and diagonals. Okay, so now if I were to ask you, can you tell me 5 different structures that Elliott observed? I'm pretty sure that 90% of you, or probably even more, would be able to repeat motive and correctives, and from the motives, impulses and diagonals, from the corrective zigzags, flats, and triangles, because it has been framed, easy to remember. So now, yesterday we said that all the waves that move in the direction of the trend, i.e. 1, 3, and 5, must subdivide into 5. Now, that's a major rule, even though I didn't present it as a rule. But basically, if they are moving the direction of the trend, they must be in 5. And it makes sense because of what I just explained a bit earlier, which is when prices are moving in the direction of the trend, they have it easier. They don't have to struggle like when they are moving against the trend, and so they cannot develop in 5. They get stuck in 3. So here we have 1, 2, 3, 4, and 5. All of them develop into 5. And as I said, that is a major rule. So here is the trick. There are 11 rules for impulses. But again, exactly as in the case of those 13 patterns, if I were to tell you, you need to learn these 13 patterns and give you the list, well, you won't be able to learn them. And if I were to give you a set of 11 rules for impulses, well, you won't be able to remember them either. So what I'm doing here is taking that 80-20% rule, right, where 20% gives you 80% of what you need, and say that, with the 3 rules that we have discussed, you have enough for discussing, for identifying the trend. And the rest is kind of a given. For instance, one of the rules, as I just mentioned, is that wave 1, 3, and 5 must develop in 5. But we don't have to learn that in the frame of a rule. We just remember that this 5-wave move, followed by these 3 move against them, is the basic foundation, the 8-wave cycle that repeats itself over and over again to form a larger pattern of the same. Remember, we call that fractal. So those motive waves that move in the direction of the trend are called actionary waves. And they have a personality. The name actionary wave doesn't really need to be memorized. I'm just calling them as per their name because then it will be easier for me to repeat this is an actionary wave. But basically, actionary waves in an impulse are 1, 3, and 5 because they are moving in the direction of the trend. They take action to produce progress. And they have a personality. They are typically thin, fast, and elegant. They tend to be fast because their goal is to make progress in the direction of the trend. They have no time to waste. So they don't overlap. You see, this one doesn't go in here, this one doesn't go in here. That's why the rules, they don't overlap. See, this one doesn't go in here, this one, and the same thing happens. They don't overlap, right? They don't have time to wait for that. Whereas the corrective waves, well, they move against the trend, and, well, they are called reactionary. As the 1 and 3 and 5 are called actionary, the ones that move against them are called reactionary. And their personality is precisely the opposite of the actionary wave. Basically, the actionary waves, we said they are thin, they're fast, they're elegant. Well, the opposite is, well, they're fat, they're slow, they're overlappy. So it's precisely the ability to differentiate the personalities of the 2 wave modalities, in other words, the correctives against the impulses, the 5s against the 3, that really occupy the hours of analysis that we spent. We look at the chart and say, does it look impulsive? Does it look actionary? Does it look fast, slim, non-overlapping, elegant? Or does it look like it is wasting time? Does it look like it's fat? By fat I mean that it's using time to develop. So basically, let's consider this. let's say that we have a wave 1 like this, and a wave 2, and now we have a wave 3. Could we call that a wave 3? And the answer is no. And you may say, well, why not? I mean, the rules are there. Wave 2 didn't travel more than 100% the distance traveled by wave 1. Wave 3 is not the shortest. We still don't have the wave 4, so why are you dismissing that? Well, I'm dismissing it because of the slope. Actionary waves tend to have a steeper slope. Why? Because they are fast. You see, an actionary wave needs to make progress. That's their purpose in life. So they go like that. So this occupies, well, let's say that this is a monthly chart, then this would occupy 3 months. But if it moves like that, well, that would occupy 2 years, right? So this is what I mean by slow, right? This is what I mean by fast. Okay, so typically what we want to consider is some sort of a clock. Let's say that we have, an old clock. Today people don't remember clocks because, well, we don't have telephones, right? We have telephones. So the clock was like this. We have the 12 o'clock here, we have the 3 o'clock here, the 6 right here, and the 9 here. Well, an actionary wave is going to be almost vertical, like an actionary wave will be at 12 o'clock, maybe at 12:30 or 1. It could even be at 2, but at 2:30 we start doubting that this is indeed an actionary wave, that this is part of an impulse. At 3 o'clock, well, we dismiss it as an impulse. We don't want that as an impulse. Why not? Because, well, it's really not having the personality of an impulse. It's not being fast. It's not having or fulfilling its purpose as an impulse, which is to accomplish, to make progress as fast as necessary. Oh, you're saying it makes sense. I'm glad. I'm so sorry that I have been so involved in my in my discussion here that I actually forgot to check on your comments, and I realized that you have been silent now until now. So I'm glad to know that this is making sense, and because actually by doing this is going to make a lot easier when you have to come to a real chart and start labeling it. So yesterday I showed you this chart that you would say, well, this is kind of textbook ideal, right? And yeah, some people, whenever I show a chart like this, they tell me, yeah, but this is the only one, you just found the one, right? But charts are not like that. So to avoid that, I looked for another chart today that I brought here. And I like showing this chart because it's so beautiful. Why is it so beautiful? This is stock that doesn't exist anymore. It's NAV. And you can see how I labeled it, right? And you can see that this is from a different trading platform because I was using, this was years ago. And you can see how I labeled it as a primary 1, primary 2, primary 3, primary 4, and primary 5, A, B, C. Very clean, very clear, right? And if we were to do the exercise we did yesterday, we were doing something very, very important that people typically dismiss because it sounds like a kid's game, which is, let's take a helicopter view. And in a helicopter view, we take distance and then we see up, down, up, down, up, down, up. We look at the main things, right? At the main moves. So when we do that, for instance, if we take this leg here from 4 to 5, we can easily see an up, down, up, down, up. You can see, if we were to label this, we would say 1, 2, 3, 4, 5. Very clean, very clear. And if we do the one here, we could see the same 1, 2, 3, 4, 5. Also very, very clear. Now, this really doesn't happen in every chart, I must admit. I mean, it's rare when you see the subdivisions of each one of the legs. I mean, typically you see one, and I'll tell you about that one momentarily. But even in the third wave, you can see 1, 2, 3, 4. And even the fifth wave of the third wave, you can see 1, 2, 3, 4, 5. Now, let's look at all those moves from the perspective of the rules. And let's see if they follow the rules. Because if they do, well, this is an ideal chart, right? So, first rule, wave 2 can never travel more than 100% the distance traveled by wave 1. Well, it didn't. You can see wave 2 here, travel probably half the wave. Wave 3 can never be the shortest. It certainly is not the shortest. And wave 4 can never end in the price territory of wave 1. It didn't, so there is no overlaps here. So for the primary count, it's perfect. There is no violation of the rules. Well, let's see for the intermediate count, for the insides of wave 5 here. We said 1, 2, 3, 4, and 5, right? Well, wave 2 didn't travel more than 100% distance traveled by wave 1. Wave 3 certainly not the shortest, and wave 4 did not end in the price territory of wave 1. So, check. Perfect. And again, here, wave 1, 2, wave 2 did not travel more than 100% distance traveled by wave 1. It was very close, but it didn't. And then wave 3 is not the shortest, and wave 4 did not end in the price territory of wave 1. And the same thing occurs here with the fifth wave of the third wave here. We said 1, 2, 3, 4, and 5. Wave 2 did not travel more than 100% distance traveled by wave 1. Wave 3 is not the shortest, and wave 4 did not end in the price territory of wave 1. It came very close, but it didn't end there. So you can see that this chart, and this is why I love this chart, and that's why I kept it, because it has everything to perfection there. Yet ABC corrective is a 5-3 pattern. Apparently it is, but we haven't gotten there yet. So we won't move ahead of ourselves. Do you use Fibonacci's to get the support 3 and 4? First of all, let me explain to you something. Fibonacci is the mathematical base of the entire Elliott wave principle. Now, this is not a comment or a statement that I am making. This is actually a statement made by Elliott himself. In other words, there is no way to use the wave principle and not use Fibonacci. Everybody thinks that Fibonacci is simply measure wave 1 and project it from wave 2 to see where wave 3 ends. Well, that's a worse way to use Fibonacci. You can use Fibonacci to learn the projections of wave 2 or wave 4 or wave 5. But to limit Fibonacci to that alone is very limited. In fact, let me show you something. In fact, the Fibonacci sequence goes like this. It starts with 0, 0, and then 1. And then it is formed, the sequence is formed by adding the last 2 digits. 0 plus 1 is 1. Then 1 plus 1 is 2. 1 plus 2 is 3. 2 plus 3 is 5. 3 plus 5 is 8. Now, let's see if this reminds you of something. The 8-wave cycle that we have been discussing, the 5 waves of impulses and motive waves, the 3 waves of corrections and the 3 rules, the 1, 2, let me put it this way, when you have in that main cycle, you remember we start like this, 1, 2, as the main cycle. This is the 1, 2. And the whole thing begins with the 1, the trend. And then the 1, 2, right? That subdivides into 5 here and 3 here. So the whole wave principle is built upon Fibonacci, the entire thing. So there are more ways to use Fibonacci than just those basic ones that people try to use without even using the wave principle. You can see so many traders out there trying to learn Fibonacci and try to use Fibonacci wherever, not realizing that the Fibonacci relationships between waves, all the waves relate to each other by a Fibonacci number, or a Fibonacci projection, or a Fibonacci extension, or a Fibonacci multiple. And when you don't know what the relationship is, just using Fibonacci ad libitum does not produce the expected results. Okay, so I hope that I answered your question. It says here, so why would it be said corrective waves don't have 5 waves? It's clear the larger move down doesn't, but the subwave of the ABC do have 5 waves. I think you answered your question yourself. Why? Well, the subdivisions are not the ones that we're describing. This is like saying, well, why do you say you are not called hand? You have a hand, you know, well, but you are not called hand. You are Charles or whoever, right? You don't call yourself by head or leg or arm. Those are the insides, so we're not going to go in there. Does Fibonacci also count for there being 13 patterns? Exactly. How come wave 5 is bigger than wave 3? Is it allowed? Well, let's see. Let's see if that is allowed. That is a phenomenal question, by the way. I suppose you are talking here about this wave here, right? Oh no, on the other one. Well, it doesn't matter. Doesn't matter where. Why is it? Well, let's see if it is allowed. Actually, let me put it this way. You don't need me to tell you if it is allowed. Why not? Because I've taught you enough already. As for you to make your own decision, is it allowed? You already know the rules. What are the rules? Wave 2 can never travel more than 100% of wave 1. Well, that's not a problem there. Wave 3 can never be the shortest. Well, that doesn't mean that it has to be the longest. Yeah, it's not the shortest, so. And then wave 4 does or can never end in the price territory of wave 1. Can wave 5 be longer than wave 3? Can wave 5 be longer than wave 1? Well, it is not against the rules, then of course it can. So here is something very important for you guys. Do not create new rules. That is the main, I would say, for serious novices that are learning the wave principle in a serious way. Because the problem is that most people get to the wave principle in a curious way. They just have the curiosity to see if it is true that you can forecast. And then they go away saying, it's not possible to forecast, just because they didn't learn the whole thing, because the whole thing takes a while to learn. And so the serious traders, the serious learners, their downfall is typically that they create new rules. Instead of attaching themselves to those 3 rules, they go with a rule like that. Can wave 5 be longer than wave 3? Well, where does it say that wave 5 should be shorter than wave 3? Nowhere. So just attach yourself to the rules. Notice that I do something very, I wouldn't say pedagogical. I don't want to sound, bringing my own things, but I do repeat the rules with the same wording, and I repeat them over and over again. And I do that purposely as a mnemotechnic way for you to remember it. Why? Because the wording of the rules matters. For instance, notice that I say wave 4 can never end in the price territory of wave 1. I never say wave 4 cannot enter the territory of wave 1, and people say, hey, by that enter, it disqualified. No, it doesn't. Wave 4 can enter. What it cannot do is end. So those specific words matter. So attach to those words, and if possible, remember the wording that I have used, because I have used it very deliberately to help you remember in ways that will be useful for you. Gabriel said, this is pure gold. Thank you very much. I'm so glad that you are enjoying. Well, let's move a little bit to a chart before we end today, because, well, today we have spoken a lot about a lot of theoretical things, and then you are going to start complaining very soon that you don't see a chart, and you want to see charts, right? So let's move to a chart here, and let's try to label a chart here together. And the reason why I want to do that is because I want you to understand the application, the clean, clear application of what I have taught you today, which is the personality of the impulses as opposed to the personalities of the corrective structures. So we said that impulses are fast, elegant, thin, that they have a slope, right? So when we want to label these, I want to label from the bottom here. When we want to label these, how would we label it? Let's see if I can do something bigger so we have a better view. Apparently not. Yeah, okay, apparently I can't. Oh, yeah, more or less. Okay. So, in answer to what somebody asked me yesterday, if we want to label this, where do we start? Well, thank you, that is food for thought. Oh, thank you. Not so sure what you're referring to, but I'm glad that it's giving you food for thought. So here, we have very clear moments in this chart where we can see how, just by looking at it, we don't even have to count it. Just by looking at it, we could see where is the path of least resistance. And the reason why we want to see where is the path of least resistance is because with the path of least resistance, then we can see waves developing into 5. Whereas where the past offers strong opposition, let me not use the word resistance because we use that word in a different way, right? Resistance or support. I'm not using the word in that sense, let's say. So the path of least opposition, let's say. Whereas with the path of opposition, they cannot develop. So here, for instance, you see here, it moves at once. Great. But look when it moves from here to here. Look how it moves. Down, up, down. And it cannot develop further. So you can right there say, well, this looks like a correction. Why? Because, well, it struggled to develop. It couldn't develop in 5. It struggled. It took a lot more time. Look how long it took to move from here to here in terms of how many bars as to move from here to here. This was probably 4 times the amount of bars, right? And it didn't even travel the entire distance, and yet it took a lot longer. Well, that's slow. And on top of slow is in 3. Let's say the wording wave 4 does not end in the territory of wave 1. Oh, I see. I guess Fibonacci is master of all, including Elliott waves. If gap happens in between of waves, will it consider as separate or inclusive? Fabulous question. Let me do this first, okay, and then we go back to the gap. All right, let me put a note here so I don't forget to answer the gap question. All right, so let's go through this first so we don't lose our train of thought. So you can see at one movement, 3 movements. You can see this big move up, and look in 3. You can see big move up, and look in 3. Is it clear for you this? Notice that I'm not labeling it. I just want to know if the drawing or the showing of the pattern here, the interpretation of what is happening there is clear. Because when you have that, based on that, you start thinking in terms of trend. It has to be continuous, right? I'm not so sure what you mean by it has to be continuous. But let's say we want to label this. How do we label it? Well, a very simple way to do it, even though we start from the bottom, when we label something, not always we have to start from the beginning. You know, if we see a pattern that we recognize in the middle, we go from that one. So for instance, I see a pattern here. When I see this chart, I see a pattern here that I recognize immediately. What is that pattern? One that we have been discussing for hours. Up, down, up, down, up. You see, let me take that away from it so you can see it. Isn't that what we have been discussing over and over and over again? It looks like that, right? So we could think that this is a 1, 2, 3, 4, 5. So this is an impulse. And so now, are there 3 waves down? Well, here is down, up, down. Okay, so let's see. If we were to label this, let's say, let's make it a little bit higher because this is a this is a monthly chart. So one way to start it, not always the best way, but since we already have the entire move, we could start from the end. So we say, well, this is going to have to be a 5. And the dip right before that Well, likely a 4, but I'm going to be open in case that is not. Well, then the top, or the top near, has to be the 3. But we already discussed that this is the end of some impulse, so I'm going to put the 3 here. And obviously the 2 will be at the low of that move, which leaves the 1. Notice that we started from backwards, right? And now we have a 1, 2, 3, 4, and 5. Do they have 5 legs? Well, they look like, because even if they don't have the 5 legs here, they look like, at least this one, display clearly those 5 waves, right? Now, it's possible that this one doesn't display them clearly, although I think they are up there, for instance. Let's open it like this. We could say, let's say, and by the way, we wouldn't have to label them, all the waves in one time frame. Not necessarily. Sometimes we have to, but in this case I'm doing this just for the sake of showing you potential 5 waves in them. So I would say 3 ended there, 4 here, and 5, well, obviously at the end, right? Does it look impulsive? Look, 1, 2, 3, 4, 5. Well, let's see. Does wave 2 travel more than 100% the distance traveled by wave 1? No, it doesn't. Is wave 3 the shortest? No, it is not. In fact, it's the longest. Did wave 4 end at the inside the price territory of wave 1? No, it didn't. So this has 5 waves. So it looks like. So now we can take them away. I just label that as a way to show you that they look like 5 waves. The wave 1, well, the wave 1 is kind of easier, no? Because if we were to do exactly the same, look at that. We have a 1, 2, the 3, the 4, and the 5. Very clear. I mean, there we don't have to argue too much. Again, did wave 2 travel more than 100% distance traveled by wave 1? No. Is wave 3 the shortest? No. Did wave 4 end in the price territory of wave 1? No, it didn't. So it applies. And this one, well, this one is very clear. Here you have your 1, your 2, your 2, your 3, where is the 4? Here is the 4, and the 5th up there. So again, this seems to be like an ideal chart that I found to show you that prices actually move in the way that the Elliott wave principle describes. But no, it's not. It's just that, this is the way that price move typically. So I'm going to end here, but before I end, I'm going to answer the question about gaps. And if there are other questions that you may have, then I will answer them as well. So let's say first, where do gaps count in this entire theory or this entire proposal? Well, again, we have wave 1, 2, 3, 4, and 5. So now we know that these all subdivide into 5, right? All the actionary waves subdivide into 5. We discussed that today, and we're clear with that, right? So now where do gaps appear? Well, this is the interesting part. There are 3 types of gaps, right? There is the runaway gap that occurs in the beginning of the trend. There is the acceleration gap that occurs in the middle of the trend. And there is the exhaustion gap that occurs at the end of the trend. So where do typically gaps occur? Well, they occur because they are in such a need to make progress that they must move as fast as possible. So where do that happen typically? Well, that typically happens in wave 3. So here we have a wave 1, right? Oops, let's put it like this. Wave 1 that, well, this is not good. Let me erase this. I think I was trying to be too cute. Okay, 1. And let's say we have a gap there. Where would that typically occur? Well, in wave 3. Wave 3 of 1, if it is a runaway gap. If it is an acceleration gap, where would that occur? Well, typically on wave 3. No, not that one. Just a second. On wave 3 of 3. And notice that it's called the acceleration gap. Why? Because there is where the trend accelerates the most, right? That typically happens in the midsection of the trend, right in the middle of the trend. And finally, where do the exhaustion gap occurs? Well, at the end of the trend. And where? Typically, the third leg of the fifth leg. So basically what I'm saying here is that gaps tend, this is not a rule, tend to occur on the third waves of wave 1, wave 3, or wave 5. In a different word, gaps tend to occur in the actionary waves. And that happens in order to produce the progress that is needed. So, are there other types of gaps? Well, certainly. But those are gaps that are called common gaps. And those common gaps, by the way, these definitions are not based on Elliott. I'm giving you the definition of gaps in terms of technical analysis. And those gaps, common gaps, can occur overnight trading. They are not meaningful. They basically mean nothing. So they don't occur on the third waves. They are not either runaways in the beginning of the trend, or they are not acceleration gaps. They are not exhaustion gaps either. So sometimes when you have a gap, that an exhaustion gap that is followed by a runaway gap like this. So you have the fifth wave, and on the wave A of the correction, there is an acceleration gap there too. And that produces something that is called an abandoned baby or an island. It's completely separated from the rest. And that occurs when the gaps, when the exhaustion gap and the runaway gap happened at the same time. Okay, so I hope that clarifies your questions. There are Fibonacci rules for Elliott wave also, right? So it's in Fibonacci, it's on top of everything. There are no Fibonacci rules on Elliott waves. That is a misunderstanding. All the Fibonacci applications of Elliott waves are guidelines. I may not have been able to hear well you said yesterday, but I will ask you again. Do we start to count the waves within the time frame, or we must go helicopter view and take the whole following larger frame to see clear patterns? I apologize for my ignorance about this. Gabriel, if I were to apologize for my ignorance in practically everything in life, I would not stop apologizing. So I'm glad that you are asking the question. And that question is extremely important. Can you label a chart in one time frame directly? Often you can. But you would be labeling a chart without context. Okay, and the perfect answer I will give you for this, and 1 second, I need to take a drink. The perfect answer will only be understood after the training is over, because 5 waves can be many things. Well, I'll give you an example. Let's say that you are in a 10-minute chart and you identify 5 waves, and you are all happy because you got those 5 waves and they are following the rules, and so those are the 5 waves. But you don't know if those 5 waves are of wave 5. You don't know if those 5 waves are of wave 3, or if those 5 waves are of wave 1. So without the context of those 5 waves, you may be betting that the thing is going to continue up, when in fact it's the end of the trend. So you need context. So typically, in my approach, and by the way, this is my approach, it's not the approach of every Elliott wave analyst out there. I always urge my students to go from monthly to weekly to 2 days or daily, and then intraday. And then as slow an intraday as you want or need to refine your timing. Remember how we spoke yesterday about the 3 important components of a trading strategy, or a successful trading strategy? And we said forecasting, timing, and trade management. So to forecast, to know where we are in the trend, we use the Elliott wave going from monthly to intraday, so we know exactly where we are in the trend. And for timing, then we move to as low as necessary. What is the best time frame? Many people ask. The one that shows the perfect setup. So if you go to a 10-minute time frame and it doesn't show the 8-wave cycle, well, that's not a perfect time frame. And if you, instead of 10 minutes, you go to 17 minutes and you see the perfect 8-wave cycle, well, 17 minutes is your perfect time frame. That doesn't mean the 17 minutes will be your perfect time frame every single time. And that is the reason why you see me using weird time frames instead of using the typical 240 minutes that I hardly use actually. I use 300 minutes, sometimes 350 minutes, 400 minutes, 600 minutes, 6 hours, whatever. I use whatever shows me the patterns clearly. And so for entries, you want to go as low as possible so the timing is as ideal as possible. Okay, let me see, there is more questions here. But these gaps normally happen on smaller time frames, 1 minute, 5 minutes, randomly on higher time frames. No, gaps happen in all time frames. They don't happen in smaller time frames. Only. They happen everywhere. And let's see, there is more. What intraday do you use? There you go. You see, everybody asked me that question. It doesn't matter. It really doesn't matter. There is not such a thing. I know sometimes people think that it's just that, I'm so arrogant that I don't want to say my time frame. No, it's that it doesn't exist for me. A time frame is, I may go to a time frame and say, well, this didn't show, for instance. Let's say we want to label this, right? And this doesn't show very well here because it doesn't. So let's put a mark there just to make it easy for us. So let's go to, instead of a monthly chart, well, we go to let's make it interesting for you so you know there is no secrets here. Let's do a 2-week chart. Okay, and see if we can, in a 2-week chart, see better subdivisions. And yes, indeed, we can see much better subdivisions. but maybe not the idea. Let's see, 1, 2, let's see, 1, 2, 3, 4, 5, 3, 4, and yeah, that could be. So let's label that again. I'm going to label this again, so you can see that with just going to those subdivisions, we can see much clearer. Now from here we see 1, 2, 3, 4, 5. This would be 3, this would be 4, and now we have here a 1, 2, 3, 4, and 5. So much clearer than the previous one. And let's say that now we want to see this one. Well, then we move to a daily. And if in the daily it doesn't show, well, we go to, let's say, 3 days. And if the 3 days don't show it, well, we go to 2 days. And so forth and so on. And the same applies to when you are doing the intraday. You go to an hourly if the hourly shows it clearly. I mean, there is nothing wrong with an hour, but, you know, there are people that think, particularly day traders, and you know, day traders typically lose money, so they always make me smile when they go, you know, with the big secret. It's a great secret. They trade off 2-minute chart instead of 1, or instead of 3. You know, there is nothing wrong with 7-minute chart or 4-minute chart. It doesn't matter. What matters is the pattern showing. Do you use tick charts in using intraday? Typically, I don't. I prefer volume charts, but what is that called? TradingView doesn't offer volume charts, so when I use other platforms, I use volume charts. But typically, I prefer volume charts over tick charts. Does it mean that tick charts are bad? No, they're good. But basically, tick charts are good for when you want to do small trades. And I typically don't day trade. I'm completely against it. And so my approach is for swing trades or position trades. So that's probably one of the reasons. Tick charts, yes, I used a lot of them. For many years I used tick charts, but they are not magical either. No? Don't think that if you use tick charts, you will have an edge over if you use contract charts or anything like that. It's not. The patterns matter. The structure matters. The 8-wave cycles matter. The identification of the trend, that's what it matters. A tick chart moving very quickly won't show you the trend. It will show you where it's moving, but not exactly where the trend is. Okay, I think, guys, we have covered plenty today. So we will see you tomorrow at the same time. Hopefully you can make it tomorrow. And we will continue building upon what you already know. And notice that you have been building quite a bit of knowledge already in only 2 days. So tomorrow we will even go deeper into impulses and know every detail of impulses. Today we only learned that they are elegant, thin, fast, and they have personalities. Tomorrow we'll go more into details. If time frame is based on a wave pattern, then we have to look at so many charts. Is there a way to short listing the instrument? Time frame is based on 8-wave pattern. That statement does not make sense at all. Time frame is not based on wave pattern. Time frames are love to you as well. I see some hearts, so I send you mine. I just don't know how to do it because I'm completely an idiot using technology and using using YouTube and streams and all that. Thank you, guys. Thank you for being with me. So many hearts to you. If I discover how to do that, I'll be sending them back. Thanks a lot. No, thank you for being with me, and I hope that this thing is going to be helping you in the future, in the near future. In fact, I would hope that by next week, you would be able to be applying the Elliott wave principle in a manner that will make your trades better. Even if you are not an expert Elliottian, you'll be able to identify the trend in an easier way just by using the logic that we discussed today. at pretty much length and detail. Thank you so much. Talk to you later. Bye-bye.